Good day, everyone. My topic for today is under the Asian model. I am your discussant, Elorna Jane C. Ocampo from Social Studies 3B. So this is the continuation of the report of Ms. Hazel Yubul. What are the topics to be discussed? First, we have comparison with Europe. Second, institution of the Asian model. Third, corporate governance. Fourth, family ownership. Fifth, rule of law contracting and the market for corporate control. And lastly, the transparency and accounting. So first, we have comparison with Europe. In Table 3.1, compares key benchmark of the major Asian economies with Europe as of the late 1980s. At that time, Japan, Hong Kong, and Singapore were comparable level of per capita income. Also, Taiwan and South Korea were still relatively poor, but they had high rate of investment in both physical and human capital. Japan had already created a society that was 100% literate as is the case in Western Europe, and it had an investment in health as shown by people to doctor ratio. Comparable to that Western Europe, Japan commitment to investment in physical capital is shown by its much higher rate of national savings in its high rate of domestic investment. The high rate of national savings appears to be constant of Japanese life. The net foreign investment occurs when a country's national savings rate exceeds its domestic investments rates. In Table 3.1 shows Japan national savings rate in the mid-1990s to equal 34%, exceeding its domestic investments rate of 33% by 1%, which constitutes Japan's net foreign investment. Also in Table 3.1 shows that high rate of investment in human and physical capital are common to the Asian model. The poor tigers all have exceptionally high national savings rate in excess of their already high domestic investment rate, indicating that they, like Japan, are making net investment in other countries, primarily other Asian countries. In Table 3.1 reveals yet another common features, a relatively low tax burden, whereas Europe's average tax burden was 40% of GDP. The Asian countries range from high of 29% for Japan to a low of 14% for Hong Kong. The major Asian countries have been able to generate human and physical capital with the relatively light burdens of taxations. Next, we have institution of the Asian model. In the previous three chapters, we examined the institutional features of Anglo-Saxon and the Europe model in terms of capital market, corporate governance, labor market, provisions, regulation versus deregulation, and the provision of income security. We also examined that the role of industrial policy, which was largely lacking in the Anglo-Saxon model but present in the European model, particularly in the French case. The same type of analysis can be performed on those countries that adhere to the Asian model. Next is the corporate governance. The modern Asian model of corporate governance developed in Japan in the early post-war period. It shares Europe's emphasis on the stakeholders over stakeholders' interests, but it focuses on the overall growth of the conglomerate organization. Conglomerate is a multi-industrial company. Asian corporate governance dates back to the family-owned international trading houses of the pre-war period called the Zaibatsu. The Zaibatsu were vertical or horizontal conglomerates that dominated Japanese industry and commerce before the World War III. They were broken up by the occupation forces as the backbone of the Japanese war machine. Before the World War II, Japanese industry was dominated by giant holding companies called the Zaibatsu, which formed a complex maze of interlocking dictatorships, banking relationships, and the family ties. By the end of the war, this concentration of ownerships had reached the point where fewer than 4,000 Zaibatsu connected family-owned almost 50% of all the outstanding industry and commerce. The new industrial groupings called Kiretsu replaced the old Zaibatsu organizations. Kiretsu can be either vertical or horizontal integrated, either a large firm in charge or the smaller firms called the children, or a horizontal association of interest groups. These new groups are less powerful than the old Zaibatsu, and at times a firm within a groupings place its own interests above those the groupings. The Keiretsu are horizontal or vertical conglomerate with a large bank in their center, although often comprised of separate companies or divisions. The Keiretsu seeks to maximize the growth of the conglomerate as a whole. The Japanese Keiretsu oversaw the Japanese growth boom in 1950 to 1880. The Japanese Keiretsu are organized around major banks in such as Fuji, Mitsubishi, or the Daiichi banks. The Japanese Keiretsu were emulated in Southeast Asia and in the mini dragon states of Asia, and in India, the home of the famous Tata Group. In Korea, they had called the Chaebols. In other Asian countries, they called Grupa or by some other local names. In table 3.1 shows Korea's Daewoo groups, divisions, and interrelated ownership structures. Over division of Daewoo Electronics owns 23% of Daewoo Motors, and Daewoo Motors own 45% of Daewoo Finance. The family of the founder, the Kim family, owns some 50% of various Daewoo divisions. The Japanese Keiretsu and Korean Chaebols use contracting based on trust, reciprocal shareholdings, and trading agreements among the stakeholders, managerial incentives to maximize overall growth, and selective coordination by the associated bank and the state. The state does not intervene directly in the operation of Keiretsu or the Chaebo. Insofar, the Japanese government and the Keiretsu themselves are oriented toward the external market in their decision-making has been based on price signal, and the state intervened little in their operations. Corporate governance and control had been top-down based on vertical horizontal guarantees and stakeholders' interests. Family ownership. The Asian corporate governance model differs from the Anglo-Saxon and European models most distinctly in its patterns of ownerships and corporate governance. In Figure 9.1 shows the greatest prevalence of family ownerships in Asia than in Europe or the United States. There is considerable family ownerships, medium-sized businesses in Europe. In Asia, families own largest businesses. A strong Confucian's family ideologies is reflected in East Asian corporate institutions where the company is the head of the family and the workers are the children. Instead of management and ownership being separate, the owners tend to be powerful families whose members are also serve as part of management team. Moreover, these families or group of related individuals owns not one company but groups of companies in complex pattern of cross-ownerships. In Europe, cross-ownerships by banks, suppliers, and customers is in common. It is in common in Asia as well, but instead of institutions owning parts of other institutions, it is one family that owns a number of companies in kind of overlapping directorate. In figure 13.3, ownership concentration of 10 largest firms shows that ownership concentrated in the hand of single individuals or families is characteristic of the most Asian countries except Japan. Notably, individual and family ownership is also characteristic of Latin America, which shares these features with the Asian model. Individual or family ownerships applies to both large and small companies, whereas the United States and Europe, family ownership is common only in the small or medium size of businesses. While in the Philippines and Indonesia, 1/6 of all market capitalization can be traced to a single family. The Ayalas in the Philippines and the Hutartos in the Indonesia. Even in Hong Kong, the territory that most resembles the Anglo-Saxon model, such as in its use of common law. More than 50% of listed companies have a single shareholders or a family that hold the major of the shares. These major families have cross-holdings in other companies, unlike in Europe, where banks hold significant shares, and Hong Kong banks hold insignificant shares and are not part of corporate governance team. In Korea, chaebols such as Daewoo, Hyundai, and Samsung in the largest single shareholders own a relative small share such as 10%. However, closely affiliated firms own enough to the company. An additional 30% to give the largest single shareholders effective control of the conglomerate. Although ownership does not equate directly with control, in most cases, the owners either directly manage the company or are represented by senior executive who manages the company in the interest of the family. In Table 13.4, control of public traded companies in East Asia. In Table 13.4 shows the patterns of ownership in various East Asia countries. It shows that in countries other than Japan, publicly traded companies are owned primarily by family or individual owners. In Singapore, Malaysia, and Thailand, there is significant state ownership as well. Only in Japan are there widely held corporations, unlike in Anglo-Saxon model where institutional investors own substantial share of stocks. Institutional investors expect for some foreign institutional investors are not prominent in Asia, and they rarely participate in management. Rule of law contracting and the market for corporate control. Both the Anglo-Saxon and the European models rely on the rule of law when they enter into contracts. Although the rule of law may be less crucial in European model, where cross-holding and bank ownership are prevalent. In Asian countries, which with the exemption of Hong Kong and India, they use civil laws. The rule of law appears to be less important in regulating and dealing among companies. The two genetic types of contracting regimes can be relational contracting is based not on formal rule of law but on personal relationships and trust, and market-based contracting is an impersonal form of contracting based on a formal contract backed by the rule of law. Market-based contracting is a primary form of contracting used in the United States, whereas relation contracting is a primary form of contracting used in Asia. Relation contracting is used in countries that have a relative weak rule of law. Prominent examples are modern Russia and China. Asian firms usually deal with other firms on the basis of personal agreements, informal enforcement and mechanism, customs, or existing trust relationships, and rely less on formal contracts and their enforcement by the courts. The courts themselves may be inefficient or even corrupt. With their family-based owned system, Asian companies appear to have resolved the key principal agent problem between owners and manager. Asian family ownership diminished the principal agent because owners are managers, while principal agents conflict do arise, however, between principal owner and minority shareholders and among the various companies owned by the same family. In cases where relational contracting is used and there is extensive cross-ownership in the rights of minority shareholders tend to be abused. In the spring of 2002, the Japanese sought a corporate rider organized minority shareholders. Foreign owners held about 30% of shares to force Tokyo Steel to pay out some of its huge cash holdings as the dividends, or at least to buy back its own share to raise the stock price. Minority shareholders attempted to place this proposal on the agenda, and shareholder meetings in action of particular adhere in Japan. Cross-shareholdings create a further risk of exploitations of minority shareholders. The family owner of number of companies can divert assets from one company to another. For example, in Korea, it is common for companies owned by one family to make uneconomical loans to other family-controlled firms. Shareholders of the lending firm are partially exploited of other assets bias such as transfer. A tunneling is a awarding of contract to firms, individual, or interests that are insiders to be conglomerate. Popping refers to financial and other support given by more profitable units of the conglomerate to support sister companies. Like in Korea, a government watchdog agency, for example, fined Hyundai Motors for giving multi-billion-dollar contract to a firm owned by Hyundai chairman's sons. The price-earning ratio is the price of a share of stock divided by earnings or profit per share. The PE, or the price-earning ratio, is measure of optimism concerning the futures. More rapid growth brings with it the exception of the growth of profit. Hence, we would expect to see higher PE ratios in Asian stock market. This is not the case. The PE ratios of rapidly growing Asia countries generally fall below those of United States and United Kingdom even during periods such as 2012. Even stock market were depressed. In 2012, Dow Jones Industrial PE ratio or forward-looking in 14 and the London Stock Exchange FTSE index is also 14, whereas the PE ratio of Asia ranged from 13 to 9 despite their higher growth rates. Scheme to pass control companies to Sun to avoid taxes and use company assets for the benefit of family members place Korea third from bottom in Asia on governance ahead of only Indonesia and the Philippines. Given the web of cross-ownership in Asian countries, hostile takeovers are practically impossible throughout Asia. There is no active market for corporate control. The most fundamental risk is not to minority shareholders but to the company itself by relying on relational rather than market-based contracting in the company fails to use price signals in its decision making. For example, in an Anglo-Saxon company, transaction would occur at the arm's length and would be subjected to rate of return calculation by third parties such as investment bankers. Poor investment would be ruled out, as would irrational asset transfer among companies. When relational contracting is used, such as market control, are largely absent business errors, large and small, as a result. Lastly, transparency and accounting. Publicly traded Asian countries are not required to be transparent as companies that operates in the Anglo-Saxon legal and accounting environment. Public investors will be reluctant to become shareholders of companies that not supply adequate accounting information. Exhibit 13.2 contrasts the disclosure requirements of publicly traded Japanese companies with the disclosures required by the International Accounting System or the IAS. The list of deviation is long and the most significant omission is any requirement to reveal transactions with related parties. Furthermore, Japanese companies can value their assets at their acquisition cost, which means that losses due to declining assets values are not disclosed to shareholders. In Japanese firm, there are few outside directors. Virtually all directors are involved in management. Therefore, accounting statements can be vetted by outside impartial directors. That would be all. Thank you for listening.